This is Let's Talk Energy, your go-to podcast for smart energy insights. I'm your host, Noah Brenner, and each week we're bringing you an inside look at the dynamics shaping global energy markets through in-depth conversations with our own Rystad energy experts, as well as some special guests. In today's episode, we're diving into the North Sea to analyze the latest developments in a place you could call the epicenter of Europe's energy industry. Since the first discovery of oil and gas at Ekofisk offshore Norway in 1969, the basin has provided Europe with its largest volumes of domestic oil and gas. While fossil fuel production has peaked in the basin, the North Sea has become a leading frontier for the development of offshore wind. Now, the strategic value of that regional energy production has become even more vital, following Russia's invasion of Ukraine and the resulting energy shock from Europe's push to kick its dependence on Russian oil and gas. So, what is the outlook for both fossil fuel and renewable energy production in the North Sea? What do companies need to do to ensure that those projects are going to be globally competitive when they do come online? And finally, how should we think about the strategic importance of North Sea energy production for the countries that are sharing it, as well as for the broader European continent, in an age of growing worries about energy security? To help us understand everything happening in the North Sea, I'm joined today from London by Simon Sjøthun, who leads our advisory business across Europe and the Middle East, and has worked on a raft of oil and gas projects, as well as renewable projects, I should say, spanning the North Sea's chilly waters. Simon, welcome to the program.
Thank you very much. Happy to be here.
Let's talk energy. So I'm sure many of our listeners know this, but for those that don't, when we're talking about the North Sea, that is split between a large portion that's controlled by the UK and a large portion that's controlled by Norway. And then there are smaller parts that are controlled by, they're in Danish, they're in Dutch waters. But generally, when we're talking today, those aren't going to be a big part of our discussion. So really, it's kind of tale of two basins right now, or two sides of the basin. So can you quickly break down for us, I guess, what we've seen in terms of the production trends from the overall North Sea, and then, what it's been from each side of the sector?
The North Sea sort of adventure, right? It started back in the 1960s. That's when there was thinking and ideas that there might be a working petroleum sort of system under the North Sea. So you started to have licensing rounds and awards and exploration, both on UK and the Norwegian sector, in that sort of mid-60s onwards timeframe. And subsequently, the first sort of commercial discoveries were made in the early 70s, and production started fairly rapidly thereafter. So in that sense, you've had 50 years thereabouts of production and history in the basin. Norway and UK, they both started development fairly similarly, right? Like any kind of traditional virgin territory, you start to find the biggest stuff first, right? So you have a pretty big ramp up, relatively speaking, in your production and your developments. That was also the case here with the big fields, Statfjord and Brent and Ekofisk and so on being discovered in those decades, and that ultimately took both areas up to a peak production in the early 2000s, around 2001 and 2004, if I remember correctly, for UK and Norway respectively. But that's when it started to diverge more, right? So from that sort of 4 million-ish barrels of oil equivalents per day, the UK sector declined quite rapidly, while the Norwegian sector stayed fairly stable around that 4 million barrels of oil equivalent mark. And the big difference is really down to gas production, whereby the Norwegian sector had sort of been blessed with bigger, the biggest gas fields in the area, right? The Troll field, Ormenlange, Åsgard, Oseberg, and so on. So that has helped to keep the Norwegian production at that level since the early parts of this millennium, while the UK sector has declined down towards a sort of 1.2, 1.3 million barrels of oil equivalent per day level today. A fairly similar start, and then it started to diverge quite rapidly at the early part of this millennium.
You and others here at Rystad have argued that the basin's status as Europe's really only material source of domestic oil and gas production give those barrels outsized importance. And so This idea that basins are geostrategically advantaged is it's something we talked about a little bit on episode 14 with Lars Eirik Nikolaisen, when we were talking about which parts of the energy sector are poised to create value, to make money. But can you explain, I guess, what this means, this idea of an advantaged basin means in the context of the North Sea today?
So I think one oil part, right? Oil is much more of a global commodity. It's literally liquid and flows around the world fairly unconstrained, and you put it on a vessel and then you can take it anywhere with very low production costs or transportation costs. While gas is much more constrained by pipelines and infrastructure, and if you want to transport across the ocean, you have to cool it down to make it liquid and put it on big vessels and these kind of things, right? So gas has a much more constrained market access than oil. I'd say oil is less important from an energy security lens, right? Just because it's it's much more of a liquid commodity. Yes, the basin or the area is mature and everything, but there's also a lot of infrastructure that has been built. So you've built all the big platforms, you've built the different pipelines and different terminals, and that means that any sort of incremental discoveries or incremental projects that are to be executed on typically have fairly decent economics also in a global context, right? It wouldn't be discoveries you could just develop from scratch without any existing infrastructure in the neighborhood. You are dependent on these big facilities that's been in the ocean for decades many times, but for these incremental decisions, it still is a fairly attractive basin. On the gas side, then the commodity is much more of a strategic sort of energy security imperative as well, right? It's about 100 billion cubic meters coming out of the Norwegian shelf, about 40 billion cubic meters, if I remember correctly, out of the UK, Danish, and Dutch shelves. And that is, stack that up against a European demand for about 400 or 350 to 400 billion cubic meters. It is a pretty significant source of that domestic energy, right? And without the Russian gas, as the other kind of big piped gas supplier, you are kind of left with this supply, right? And the balance more or less has to be made up with LNG imports from other places in the world. You don't want to be reliant on those imports, and gas is a much more, let's call it, infrastructure constrained type of commodity than the North Sea becomes quite central and very important to maintain that energy security lens and resilience. Economics, more kind of resource intrinsic point of view, the same story that I told on oil still applies to gas, right? You built a lot of the platforms, you built a lot of the pipelines. So again, each incremental kind of cubic meter of gas you bring to the market is typically very competitive, especially measured up against the US LNG, which typically is looked at as the marginal supply. Piping that gas from the North Sea to the continent to be used is typically much more attractive than LNG imports. But you simply don't have enough of it. That's why you still need LNG at the end of the day.
How does this play out on the ground for a company working there? I mean, if we're saying, look, there's an opportunity to make money in this sector moving ahead over the next couple of years, how do these advantages manifest, I guess, in maybe a corporate bottom line?
If you find a pocket of oil fairly close to existing infrastructure in the North Sea, that should be a fairly attractive development stacked up against kind of shale and oil sands and these type of things that you typically, otherwise would view as the most expensive oil resources in the world. So it's not that it's outcompeted per se, right? It's just that it's difficult to find, and you don't have an endless pipeline of new projects to bring to production. It's not like shale where you know that there are hundreds of square kilometers of formation rock that you can just drill and drill and drill and drill, right? You don't have that certainty in this basin. So that's kind of the drawback, right? And then from a gas perspective, it's you basically get piped access to the most premium gas market on the planet, right? So European gas prices are very high. So just from a pure kind of dollars, euros, and pound perspective, if you can produce that gas in the North Sea and sell it at the TTF and NBP price points, then that is a pretty decent margin that you're making, right? And a higher margin than what you get from let's call it netback mechanism, or selling sort of the American gas in Europe with every cost element in between, right? If you subtract that, then that what you're left with there is less than what kind of the typical North Sea cubic meter of gas would be left with. If you can find the resources, in particular if you can find some gas, it's very attractive to bring to the market, but it's tricky to find, right? I mean, that's kind of the downside, if you want, of playing in this basin.
You've mentioned a couple of times kind of these differences between the UK and between Norway. We're going to talk in just a second about the UK budget and how that might impact the outlook there. But first off, you've mentioned rocks, you've mentioned fiscal regimes. You've kind of laid out an idea of rocks, fiscals, and time when you're thinking about how to compare these two. So break it down for us in terms of what rocks, fiscals, and time looks like on each side of this, and then how that's led to these outcomes.
So think about rocks as being that's sort of the resource intrinsics, right? Before you kind of mix in all of these kind of human elements, right? Where is the resource located? What is the reservoir quality? How big is the accumulation? How easy is it to take it to the market with existing infrastructure and so on? All of that kind of plays into this kind of rock element, right? Or just is the rock good? From a North Sea perspective, UK and Norway is fairly similar from a geological point of view, right? But the UK has always been a little bit ahead of Norway. More exploration wells drilled. They were faster with developing all of the different fields. So you're a bit further ahead, if you want, right, on the sort of maturation scale than the Norwegian sector. And Norway is also helped by being able to tap into the Norwegian Sea and the Barents Sea as sort of additional provinces in a way that the UK can't really do, right, in the same fashion. West of Shetland, perhaps a little bit, but it's not to the same scale. There's still a bit more, juice left, literally, in the Norwegian sector, statistically speaking, because it's not been as drilled up and as developed as on the UK sector. It can always be surprises, of course, but that's, then you're playing against the odds, so to speak. Then on the fiscals, which obviously with the budget that was at the time of recording was released, mere minutes ago, also make a big impact. Like, what is the distribution of the resource rent? So basically, the revenue coming out of these resources between the companies that are developing this and between the state, right? I mean, ultimately, nature gives these resources away for free. That's just the headline number, the tax rate, right? But there's a lot of nuances there on capital allowances and depreciation schedules and all kinds of stuff that is perhaps a bit too technical. But there's a lot of things going on under the hood that ultimately decides how this resource rent is distributed. And ideally, right, it should be a neutral system whereby both the companies and the state is all happy, right? They both have aligned incentives. But you can have fiscal systems that don't have that, where the state, or for that matter, the companies get an outsized portion of this resource rent cake, right? And that can lead to, suboptimal development kind of concepts and suboptimal use of the resource base that's in place. And that's where there's a pretty stark difference between the Norwegian sector and the UK sector, whereby the UK sector has seen multiple, probably about 10 different, at least double-digit different tax regime changes over the last 20 years, which just makes it very difficult to plan, right? You don't really know what parameters you're operating under. While the Norwegian sector has been much more stable, you've had some tweaks here and there, yes, but it's by and large has followed, the same rules over the same time period. And there's not many times in your life where you get paid for doing nothing, but in this instance, right, doing nothing just builds confidence, and that builds security and comfort around putting literally billions of dollars or euros and pounds into these projects, and that you get the returns that you're expecting, and so on and so forth. So on fiscals, there's a pretty big difference. I'll give the Norwegian side a sort of a green flag there, and the UK side, it's hard to not give it anything else but a big red flag. The last point, and I think the last point that's time, and I think that's, let's say you have resources in the ground, right? Not yet developed, not yet able to bring to the market, but just how much time does it take to find resources and bring them to the market, right? I mean, those resources have no value unless you can sell them and get revenue. And that time is typically considered to be too long, right? And the Norwegian sector in particular, it's a big sort of pain point now, just how much time it takes to take these new projects to production. That's also where the UK has been a bit better, right? The UK has been faster at developing things, but that also reveals a bit of a philosophical difference, I'd say, between the UK and the Norwegian sector. The UK sector has been more of a laissez-faire, kind of everyone building their own system, and there's no kind of overarching or kind of architectural design philosophy, if you want to use those kind of words. But while in the Norwegian sector, through Gassco and Gassled and Equinor as the big dominant sort of operator, and Petoro as a big partner in the big fields, also representing state interest and so on, you've had a much bigger, or much more stronger forces in trying to coordinate everything to maximize the overall pie, right? While the UK sector has a lot of different hubs, smaller hubs, and many different pipeline systems, the Norwegian sector would have bigger, more stronger hubs with perhaps more consolidated pipeline systems. I think it's a bit, the jury is still a bit out, in my opinion, on this whole time element, because yes, you can criticize and you can point to the Norwegian sector for taking a lot of time from from discovery to production. But perhaps that time is actually worth it because you end up with a much more efficient and productive production time, right? Where you have lower unit costs, lower emission intensity, and ultimately higher margins. So that's a bit some of the reflections on these, rock time and fiscal kind of framework of thinking about the resource competitiveness across different sectors.
I want to talk specifically about the UK because, as we mentioned earlier in the program, we're taping just a few hours, we're literally actually probably less than that, after the release of the 2025 budget, or the latest budget, from UK's Labour government, which keeps in place the EPL, the excess profits levy, or energy profits levy, which keeps it in place through 2030 at basically a tax rate of roughly 78%. I think proponents of that say, well, it's the same as Norway. You pointed that out earlier. But at the same point, we've got trade groups, industry saying, look, this is stifled investment in the sector. And some of that has to do with the way that it makes allowances for investments. But so as it stands now, I mean, I guess, what does this keeping in place mean for the companies working there? And I should just give a caveat that, look, this is under discussion. OE UK has definitely asked for a meeting with the Labour government to try to argue for some changes here. But as it stands now in the proposed budget, things stay the same. So what does that mean for how that production trend might look in the UK?
Imagine you making a big acquisition or making a big field in the field development decision, and you put lots of money on the table, and you expect this and this tax rate, and then suddenly that is changed, right? And you have to pay 30% more, or it just changes the rules, right? And that just creates a lot of frustration. It creates uncertainty, and it creates an environment where you're if you have two opportunities of fairly similar nature, one in UK and one elsewhere in the world, you are all else equal more likely to look at deploying that capital and that focus on the opportunity somewhere else, right? Just because you have greater security or greater comfort around what rules you're playing with, right, or rules you're playing by. So in isolation, the EPL as it is nothing particularly gregarious with it, right? It has a fairly neutral kind of approach, right? Yes, you have a high tax rate, but you also get pretty sizable allowances and so on. If that was in place from day one, right, then you would have played by the same rules, right? So it's the volatility of the rules changing. That's really the damaging part, right? It doesn't help with comfort, right? And this is not really something only applying to the oil and gas industry. Across any type of industry where you have huge capital investments that are supposed to be alive and pay back over many decades. The EPL is supposed to now end in 2030, right? But will it? I mean, we saw today in the budget that the income tax thresholds were also postponed, right? They were supposed to end in 29, I think it was. Now they will be frozen until 31. If you are sitting there trying to do your calculations on whether or not this project will make the return that you're expecting, it just makes it really hard know what to plug in, right? There's too many scenarios and permutations you can play with, right? I think that is really what's damaging the investment activity that otherwise should have been there, right? Just looking at it from this rock and time kind of perspective that I outlined earlier in the conversation.
Is there anything that you would recommend that Norway needs to do, or is it really just the best thing to do is simply leave well enough alone?
Not many times you get paid for not doing anything, right? I think, and that's also for anything that is kind of positive, if you want, from an oil industry perspective, right? I think the COVID changes was a mistake, right? You open Pandora's box by introducing changes when market conditions, turn either really bad or really good, right? It's just, you have to find a system that works through these types of cycles, right? I didn't look at the COVID package with sort of big welcoming eyes. I think that it's just distorting this sentiment that you should be very careful about touching these rules, right? And then the changes made after the COVID package, where you kind of moved away from, again, we're getting into some of the technicalities here, but you moved away from like a multi-year depreciation schedule down to a sort of more of a cash flow based tax system. I think it's not only the tax system that is important or makes kind of forms part of the regulatory environment, right? There's also access to areas that might not be open for activity. It can be CO2 taxation and electrification mandates, and it can be access to power and all these kind of things. So granted, there's more to the, let's call it, the regulatory package than just the fiscal side of it. But that's obviously, the fiscal is very much the hard currency that you see at the bottom line, right? So that's why it certainly gets an outsized importance in this discussion.
I want to shift over and talk a little bit about corporates, the companies that are working here, the corporate landscape that we've seen evolve over the past maybe decade or so. And I mean, can companies simply kind of carry on? They've been working in this basin for, as you said, perhaps 50 years. Can companies kind of simply carrying on doing what they're doing and count on that particularly advantaged access to markets, to infrastructure, to be able to generate the returns that they need? Or does there need to be kind of a step change improvement in how companies are actually accessing these resources?
In the early days, it was the big companies, the Shells and the BPs and so on, that sort of led the charge, right? You need those types of big companies to lift those initial projects where you have to build everything from scratch and develop the whole industry, right? As time goes by and those big discoveries and the big projects are no longer there, and it becomes much more of a nitty-gritty industry of squeezing out a bit of extra resources here, a bit of extra resources there, right? And you also enter kind of the decommissioning side of the story. It's not very compatible with the competitive advantage and the type of business focus that these big companies wants to have, right? They want materiality. They want to be these big new developers in new basins, right? So it was a natural sort of change of guards. I think that started in, let's say, around 2005 and onwards, in both in Norway and UK, where you saw a lot of so-called independents, right, or smaller companies come in and acquire some of these bigger, older fields, giving them a lot of tender love and care to redevelop them, invest more, and really try to maximize the value out of these fields. And by and large, I think that's been a very successful and a natural way of maturing a basin. So success story so far, and you also see different other regions of the world looking a bit at the North Sea to see what happened here. Can we recreate this where we are? For example, in Brazil, you've seen some of these types of initiatives. You've seen it also in Southeast Asia, where you also had the very recent JV, right, between Petronas and Eni as an example, mimicking a bit the JV that Eni made with Boa in the Norwegian sector.
Do we see further consolidation? Is there further running room to become more efficient for players to get bigger, the players that do remain?
Just to use the Norwegian sector as the example in this case, you had about 25 active companies in 2000. That rose to about 55 companies around 2013-14. And now it's down to 25 again. Unless you do something with, the top 5 in a way, or at least unless you do something with Equinor and Epitor's portfolio, or the state's direct financial interest, it's just like it's such a all-encompassing portfolio, right? That I struggle to see a bit how much more consolidation you can do of a bigger scale, right? Of the same nature that you've seen before. And with the new tax system, you also don't have the same type of tax synergy mechanisms that also have led to quite a bit of transaction and consolidation activities, prior to that change back in 22. Yes, you still have Total and Shell and ConocoPhillips as the majors kind of remaining on the Norwegian sector. Can something happen there that would kind of follow the rule book that we just laid out about bigger companies? It's not at the same scale as the Statoil Hydro merger and some of the other big divestments that you've seen over the last decades in both the UK and Norwegian sector. The big flashy things have perhaps petered out a bit, but you still have to see lots of M&A and commercial movements, if you want, on the more nitty-gritty side of things. You need to align interests between different satellites, developments, and hubs to align commercial interests and so on. And that's where the M&A market is very important. It goes back to the time dimension that I mentioned earlier. A lot of the delay in getting resources to the market is that you have misaligned interests, and that just means that you're kind of stuck in commercial negotiations a lot. And M&A is sort of one mechanism to kind of force or to alleviate those types of misaligned interests. But that is just very nitty-gritty work. It's not the big flashy stuff that you read about in the papers.
I wanted to shift over and talk a little bit about offshore wind, because as the oil and gas production, particularly on the UK side of the North Sea, has declined, we've seen a pretty rapid rise of offshore wind installations. I believe UK is the largest installed capacity of offshore wind. Certainly it's been a priority for Equinor and for Norway from an energy policy perspective. But you've said that you actually see perhaps maybe limited running room for further offshore wind, or at least some economic headwinds to further development of these really large installations that we've seen so far.
It's been an amazing journey for in particular, the UK sector over the last decade, just how much capacity has been installed. From an offshore wind perspective, it's the Dutch and Danish and German and UK sector that is really the booming areas, while the Norwegian sector doesn't really have the rocks, to use the same type of resource, sort of nomenclature way of talking about things. The Norwegian sector is too deep, the water is too deep, it's too far from the market, while you have bottom fixed offshore wind all across the southern part of the North Sea, right? So it just is one of the best locations in the world to actually do that, right? But offshore wind ultimately ties into the power market, and it's it's a variable source of energy, and that just means that the more capacity you add and the more percentage points of this type of energy or electricity you get into the power system, the more difficult it is to maximize the value of the electricity produced, right? You get this cannibalization effect. And I think that's what we've seen a lot emerging over the last years, these negative pricing environments and so on. And you combine that also with the cost inflation that you've seen across any industry really, but also for the offshore wind and industry. The economic reality is not the same as it was, the last decade, when you had low cost power market that was ready to absorb these electrons, and you also had very low interest rates that made these investments and the debt related to them very affordable, relatively speaking. The European population at one point have to accept that we have to do these things onshore, right? I mean, doing things offshore is complicated, it's expensive. Maintaining the big platforms out in the North Sea costs enormous amount of money, right? If it wasn't for the valuable resources that's there, you wouldn't do it, right? The economic reality of doing wind onshore and also carbon storage onshore is vastly different than what it is offshore. I'm questioning if we kind of hit a bit the ceiling of what you can do offshore, and if you want more activity, you need to move onshore. You need to something's got to give. And is that what has to give that you need to accept these types of activities and industrial activity also in an onshore setting? I'm a bit reluctant perhaps to say that you'll have the same type of booming kind of outlook for the let's call it the other energy sources in the North Sea setting as you've had over the last decade.
Earlier in the program, we talked about the geostrategic advantage that natural gas production in the North Sea has, selling into an established market, a high price market or high value market. I mean, is there a similar argument that offshore wind could have that same geostrategic advantage? If it's able to move into Europe, if there's infrastructure available, or is the dynamic different there?
It's the same dynamics, right? So obviously, having locally produced electrons, so to speak, it's that speaks to the energy security angle. So from that point of view, it's certainly a very important energy production source for Europe, right? I mean and that's also why the governments across the North Sea have put a lot of effort on developing the offshore wind industry, right? Because of this particular reason, along with the decarbonization agenda to decarbonize your power sector and subsequently the other parts of your energy system, right? So that all kind of resonates and stack up. Have you taken the lowest hanging fruits, right? And the pain points are kind of emerging that starts to ask these more difficult questions, right? And you've seen the debates in Norway around electrification of offshore gas turbines, right? I mean, that was easy 10 years ago. It's not that easy today because you want to use that power for many other things and you don't want to create the higher power prices and so on for the population. So it's all of this has become much more politically tricky than what it just was 10 years ago. So I think that is why you're bumping up against some of these realities that perhaps have to become higher on the agenda than what's been in the past, where you've been able to sort of coast along and not really touch those difficult themes in the same way.
Well, and if Europe's demanding green electrons, those green electrons could be met by, as you pointed out, perhaps cheaper sources than offshore wind, if you're willing to generate onshore or even solar.
You need to build redundant supply chains. That has a cost, right? So in a perfect world, right, you sort of need Russian natural resources, you need Chinese manufacturing capacity, you need American capital, and you need European carbon taxation, right? You need all these things to fire on all cylinders. That's when things happen, right? Now we're trying to subtract all of these different elements from creating change and creating this transition story, and it's just causing suboptimal solutions, right, from what the planet and its resources otherwise can deliver. So coming from that angle, a bit kind of can't we all just work together and optimize angle, then it pains me a bit to see all of these developments that we've seen over the last years on this topic. And I think that plays a bit into this tension that I've talked about, right? It's not that easy to just build more of what you've done because you're hitting certain thresholds that makes it less easy than what it was when you did it the first time around.
Well, and taking a step back and thinking about kind of maybe more macro energy and climate policy, I mean, really interesting to see kind of the two sides of the North Sea in the UK and Norway, perhaps kind of personifying some of the debates we're seeing around that we've seen from COP30, but kind of the debates we're seeing around energy pragmatism and the idea of, well, in the UK at least, perhaps still persisting that a successful climate policy attacks or limits the upstream production of fossil fuels, whereas Norway is probably focused much more on maintaining production of fossil fuels, but also then incentivizing use of electricity, of electrons in ways, whether that's through incentivizing EVs and other things. So, I mean, kind of really interesting sort of dichotomy that we're seeing in one basin that's perhaps maybe playing out more broadly across the world. I mean, does that resonate? Do you think that's accurate?
We've been looking into this quite a lot, right, through this kind of Scope 3 emissions and how that relates to field developments in the North Sea, both on the UK and Norwegian sector. You quickly get into this discussion around elasticities, right? So if you don't produce a barrel or a cubic meter in the North Sea, how much of it will be produced elsewhere in the world, right? the lower your demand outlooks are, and the more kind of abundance you have of production capacity of oil and gas globally, the higher the elasticity is, and the less kind of, let's call it, a net emission bang for your buck do you get to reduce local supply, right? I mean, if Saudi Arabia has 2 million barrels of spare capacity, they can just replace those barrels that you don't produce here, right? And then you're kind of more or less even Steven, right? So it's only when you kind of increase your demand outlooks, you're more in this sort of, if you think about the latest IEA report in the steps, or the current policy scenario, when you have still growing demand and these kind of things, when you start to stress the production system or the production capacity system globally, that's when, obviously if you constrain supply, it will have a price impact much more, because the system is much more inelastic. And then you can start to talk about sort of, if you don't produce this barrel, only half of it can be replaced somewhere else, and that makes a pretty big dent on your scope 3 kind of net emission logic. But at the same time, in that world where you're in that type of high demand environment, or the value of that commodity is also very high. So if you then divide kind of the value of this project on the net emissions that you are saving, it becomes a very, very high abatement cost. And I think, if you analytically and logically think about how to abate your emissions to reach different targets, you're starting in the wrong end of the scale, right? I mean, one example we looked at, you ended up with $2,500 per kilo. It was just like, way off scale. Like you're better off just building a direct air capture facility and offset those emissions that way instead. So to me, it just immediately kind of comes into this logic world of, okay, let's just follow the global marginal abatement cost curve, right? Or do we want to follow each country's way of trying to optimize for their own emissions and emission statements and goals and targets, right? Do something with demand, and then supply will follow. I think that's certainly the sentiment that we've been uncovering through the work that we've done in that particular sector and that particular theme.
Well, and if you go the other way around and start with supply, then you start facing these questions around affordability that have plagued many governments, and particularly have dogged the UK here recently with these higher energy costs. Simon, thank you so much for joining us, for unpacking these really complex interactions here in the North Sea. Really enjoyed the discussion.
Thank you very much.
Let's recap. North Sea oil and gas production has peaked, and further offshore wind development faces economic challenges. But both sectors can continue to provide vitally important resources if countries manage them properly. And that management is key, because remaining production from the basin is more important than ever to Europe's energy security, as the continent tries to end its dependence on Russian hydrocarbons and keep its industries globally competitive. Companies working there can get a tailwind from their strategically advantaged location, but they will need to build scale and to rethink their development strategies in order to bring down costs if they're going to turn a profit in a region where taxes are high and regulations are stringent. Thanks for listening to Let's Talk Energy. This podcast is a production of Rystad Energy, produced by Laura Rodriguez-Skaug and Boda Og. Check out the show notes for further analysis of the topics that we've discussed today, and connect with us on social media. We're at Rystad Energy on all your major platforms. While you're there, click the like button, subscribe, and leave us a review. You can also keep up to date with us on our website. If you'd like to send us questions or reflect on today's episode, or maybe you've got an idea for a future one, email us directly. It's podcast@rystadenergy.com. And most importantly, don't forget to join us next week for more Let's Talk Energy.